Welcome to Market Recap. I'm Daniel.
And I'm Mira.
So today is Monday, August 10th, 2026. And, if you're just glancing at the S&P 500, it closed completely flat today at 7,753.11. But that headline number, it is totally lying to you.
Oh, absolutely. Underneath that, flat surface, today was just a massive tug-of-war. I mean, we had crude oil surging on a North African drone strike, Thai valuations basically hitting a wall despite a $500 billion AI deal, and on top of all that, a really hawkish Federal Reserve sending bond yields climbing.
Yeah, exactly when the market desperately needed a breather. So here's our roadmap for today's deep dive. We're going to break down the global forces that set the stage overnight, unpack those sudden geopolitical shocks that rattled U.S. trading hours, and then wrap up with the major corporate shifts you actually need to know about.
But just as a quick reminder before we really get into the weeds, everything we discuss today is strictly for market context and discussion. It is not personal investment advice or, an investment recommendation.
Right. Spot on. Okay, so let's get into it. Session 1. What set the stage before the U.S. session?
Well, to understand today's chaos, we actually have to look at the weekend data out of China first. It was pretty rough backdrop. Their July CPI, so consumer prices, missed expectations, rising only 0.5% year on year.
Wow, just 0.5%.
Yeah. But the bigger deal is their PPI, the cost of goods leaving the factory, actually fell 0.7%.
Right, which is a textbook case of what we call manufacturing overcapacity as exported global deflation.
Exactly. They are producing way too much. Their domestic demand is weak, so they just dump those cheap goods on the global market to get rid of them.
Which honestly sounds great if you're a central bank fighting inflation, right? Like, hey, cheap goods. But Japan kind of ruined that narrative.
They really did. So on Sunday, August 9th, right around 7:50 p.m. Eastern Time, the Bank of Japan released their summary of opinions from their July meeting. And it was just shockingly hawkish.
Wait, really? That hawkish?
Yeah, very. There's strong support for accelerating their monetary policy normalization. And the reasons were fascinating. They cited inflation from the weak yen, obviously, but they also explicitly called out robust AI demand as pushing up prices.
Oh, wow, yeah. Which is wild to think about, like physical AI infrastructure draining power and resources and causing local inflation. But then fast forward to 7:47 a.m. Eastern Time this morning, Kyoto News reports that these BOJ rate hike signals actually led the United States to cooperate in a joint currency intervention to support the yen.
Right, like a coordinated central bank effort to just stop the bleeding.
But I have to push back on that a bit. I mean, are central banks just plugging holes in a dam here? We know that carry trade unwinds act as a global liquidity vacuum.
Well, for sure, it's structural.
Right. So if global rate paths are fundamentally diverging with Japan hiking and the U.S. dealing with its own sticky inflation, can a joint currency intervention actually reverse that fundamental liquidity drain?
That is the big question traders were wrestling with this morning. Interventions can punish short-term speculators, but you can't intervene your way out of a shifting yield curve. So markets basically woke up to this massive global liquidity squeeze.
Which makes perfect sense. Okay, I'm going to briefly wrap up this section. So a global liquidity squeeze set a really tense tone. Let's take a quick break and then transition right into the U.S. session chaos.
Sounds good.
All right, we're back. Session 2. What moved markets during U.S. trading hours today?
Well, almost immediately, we got a massive physical shock in the energy markets. At 2:18 p.m. Eastern Time today, an unknown drone strike hit a fully loaded fuel storage tank at Libya's Zawiya oil refinery.
Yeah, that triggered major explosions and this massive diesel depot fire.
Right. And this happened in a geopolitical environment that was already a complete powder keg today.
Exactly, because earlier at 10:26 a.m. Eastern Time, President Trump posted on Truth Social, totally rejecting Iranian claims for compensation regarding that recent Strait of Hormuz conflict.
And he didn't just reject them, he actually counter-demanded billions of dollars for regional damages.
Yeah, across Lebanon, Syria, Yemen, and Gaza. And he explicitly stated that the U.S. retains the, quote, ability to escalate. Now, the market reflex is to always treat these geopolitical events as, unpredictable natural disasters. Just random bolts of lightning out of nowhere.
Right. Algorithms just trade the panic.
But if you actually apply a game theoretic lens, this isn't random chaos. This is calculated geopolitical escalation as game theory brinkmanship. Both sides are just aggressively maximizing their leverage right ahead of those Oman-mediated shipping negotiations.
That makes a lot of sense diplomatically. But for the market, honestly, regardless of whether it's a negotiation tactic or a random strike, the impact is identical. This acts as an oil shock as a multi-channel margin tax.
Yes, which just eats into everything. Freight, manufacturing, consumer wallets, everything.
Exactly. And WTI crude surged 5.22% on the news to close at $82.26 a barrel. And the energy sector, XLE, naturally rode that wave, gaining a massive 4.66% today.
But an oil shock like that puts the Fed in just an awful spot. Because right as oil was spiking, at 2:04 p.m. Eastern Time, Cleveland Fed President Beth Hammack gave this live address.
Yeah, and she basically poured a bucket of ice water on any rate cut hopes. She said the current policy rate is not meaningfully restricting the economy.
Which is wild to hear right now.
I know. And she followed up by saying that now is the time to start acting with rate increases.
The rate increases, not just holding, but hiking. I mean, it's classic central bank paralysis under supply-driven stagflation. They can't drill more oil to fix the supply chain, so they threaten rate hikes instead. And the bond market heard her loud and clear.
Oh, they definitely did. The 10-year Treasury yield climbed 3.9 basis points to hit 4.699%.
And just to add one more layer of friction to the whole supply chain headache, at 1 p.m. Eastern Time, President Trump extended the Jones Act shipping waiver, but narrowed it specifically to just energy and fertilizers.
Meaning general shipping costs are going up for basically everything else.
Exactly. Okay, so to wrap up session 2, we basically had this brutal dual shock today, rising oil acting as a physical tax, and hawkish Fed rhetoric sending yields higher, squeezing the broader market. Let's signal a quick break, and then we'll dive into the corporate news.
Well, welcome back. Let's get right into session 3, corporate events recap and what to watch next.
So those rising yields we were just talking about, they're essentially acting as risk-free yields, as gravity-compressing multiples, and high-duration tech is where that gravity pulls the hardest.
Right, and Apple felt that gravity very early today. At 6:39 a.m. Eastern Time, so way before the Bill Jeffries downgraded Apple to underperform and cut its price target to $263.66.
Ouch. What was the catalyst?
They cited canceled plans for a highly anticipated all-glass anniversary iPhone and also rising memory component costs. It dragged the whole sector down, and the Nasdaq Composite ended down 0.32% to 26,605.36.
But then, amidst all that tech weakness, we had this massive disconnect in the AI space. At 12:24 p.m. Eastern Time, Nvidia announces a $500 billion AI financing pact.
$500 billion. It's just an astronomical number.
$500 billion. And it's with Wall Street giants like Apollo, Blackstone, and BlackRock to build out massive AI data centers using purely third-party private capital.
But here's the crazy part, right? Despite a $500 billion vote of confidence hitting the wires, the tech sector ETF, XLK, still closed 0.9% lower today.
It's the ultimate irony.
It really is. It's a perfect example of AI capex as a self-referential valuation loop. Private equity lends money to buy Nvidia chips, which validates Nvidia's valuation, which attracts more lending. But even massive private capital can't instantly override the macro gravity of the Fed threatening rate hikes.
Exactly. Gravity always wins, although the physical spending spree definitely isn't stopping. At 7:43 a.m. Eastern Time, Intel had a $15 billion stock offering specifically for foundry expansion, and reports said it was multiple times oversubscribed.
Yeah, there is still ravenous appetite for domestic semiconductors. And separately, Microsoft is expanding its homegrown AI chip production, challenging merchant silicon makers.
Right. Okay, before we look ahead, we have to read the closing bell joke from our main daily briefing source, because whoever wrote it captured the absolute absurdity of today perfectly.
Oh, let's hear it.
Okay. Quote, "And that is the closing bell on a day where Wall Street successfully rounded up a cool $500 billion to build more AI supercomputers, but apparently still couldn't buy us a single interest rate cut. Between a drone strike in Libya sending crude oil up 5% and the Fed's Beth Hammack calling for even more hikes, the only thing inflating faster than our tech valuations is the cost of gas." So, if your portfolio felt a bit flat today, just remember, at least you didn't get downgraded by Jeffries like Apple did. Sleep well, and let's hope tomorrow's market is powered by artificial intelligence and not actual premium diesel.
That is painfully accurate.
Seriously. So, Mira, what should our listeners be watching over the next 24 hours?
Okay, a few key catalysts. First, watch for overnight Iran and Hormuz headlines, plus any updates on that Libyan refinery. Geopolitics is driving the bus right now. Then tomorrow, at 6 a.m. Eastern Time, we get the July NFIB Small Business Optimism Index.
Always a good pulse check.
Yep. Then at 10 a.m. Eastern Time, July existing home sales data drops. Midday brings the EIA short-term energy outlook, which is obviously crucial given today's crude shock. And finally, between 11 a.m. and 1 p.m. Eastern Time, look out for the Treasury buyback announcement, followed by the 3-year note auction.
All right, awesome.